Good morning. Happy Saturday. I hope you are doing well. We're live here this Saturday morning about noon here on Saturday. We're going to start a little bit of a new feature here every once in a while. I think we may call this Brunch with Brandon, but we're super excited here today. We're going to talk about the rising rates impact on the housing market. So some of you may have seen the blogs that we've written and heard our podcast about the topic recently, but it's obviously very relevant, especially here in the Seattle area. So we're going to spend some time talking a little bit about this. And if you are in the Seattle area, unfortunately, we're here after a loss from the Mariners last night. A bunch of coworkers and a bunch of friends were going to that game. So it was a little bit of a heartbreaker. But after, 14 in a row, it is what it is, right? So we're still looking okay, I think. Anyways, today we're going to talk about the impacts of rising interest rates on the housing market and how that not only relates to the buyers, but sellers and just the market in general. So the first thing that I really want to spend some time on is just kind of where we're at. So going back to basically fall of last year, end of last year, I believe average mortgage rates were somewhere 3% or even potentially lower. We have been in this great interest rate environment, whether it's for housing, leverage, I mean, you name it, right? Interest rates have been very low for a long time. And now, as we move into 2022, the party's over. The Fed has decided that they are going to raise rates and pretty dang aggressively. And along with that has come mortgage rates, has come bond rates, has come you name it. And so we're really obviously starting to see the impacts of that. Now, all that said, remember that here we are, average 30-year rate might be somewhere around 6%, 5%, somewhere in that range. But remember that historically, that is still a very low interest rate. So we can talk about how much rates have risen, and don't get me wrong, it's important. They've doubled in about 6 months, right? That is a very quick rise. But at the end of the day, where the rate actually is still accommodative, is still loose, is still, pretty low from the historical standards. But I think it's really important to touch on that and kind of share where we are, where we've been, before we talk about what this rising rate impact may mean, because again, remember that rates are still historically lower than they've been. Now, all that said, the first 6 months of 2022 have been the worst worst 6 months in the bond market ever. So that gives you an idea of how quickly and how fast these interest rates have risen. To see the worst bond market ever in 6 months really shows the power of what has happened here in the interest rate environment. Because as interest rates rise, bond prices fall. Now, all that said, we're not here to talk about the impact of rising rates on bonds. We're here to talk about the impact on real estate. And so I'll split this up into three categories. I'll start with the buyers, I'll talk a little bit about the sellers, and then I'll talk a little bit about the market in general. So I think the first thing on the buyer side is to really understand that what this does is now that the party is over and free money, so to speak, is kind of off the table, number one, buyers need to be a little more cautious in what they're purchasing and the offers they're making and how much money they're putting down. The financing of the deal becomes so much more important than it was just 6 months ago. So that's the very first thing that I'll share. To give you an example, kind of drew up a couple options here. This isn't going to be exact, but this will give you a little bit of an idea. So just 6 months ago, let's say you were able to get a 3% rate on a 30-year loan. If you were purchasing $1 million house, that total monthly payment would have been $4,200 or so, 42 and some change, okay? So basically, if your budget was $4,200 a month, you could easily be looking at $1 million house. The interest wasn't as much of an impact. Now, fast forward to today, and let's say you're looking at the same exact house, but now instead of 3% mortgage, you can get a 6% mortgage. Factoring in all the same ideas, 30 years, basically, even looking at a loan of $750,000, I apologize, I'm looking at my calculations here. Looking at a loan of $750,000, the monthly payment is up close to about $4,500 a month. So you can see that just from the increase in rates from 3 to 6, your basically your monthly purchasing power dropped your total mortgage option down about 250 grand in this case, right? And you're still spending more than you would have for $1 million just 6 months ago. So this is really important. I think a lot of people kind of base their home purchase price on the monthly payment. And so this really illustrates how powerful that is, right? Again, $750,000 at 6% costs about $4,500 a month. And just 6 months ago, we could have easily gotten $1 million loan. So how that relates to your purchasing and what you might actually be looking at, if you were looking at $1 million home just 6 months ago, now all of a sudden you may be looking at $750,000, and it's not because the home has changed, right? It's not because your budget has changed. It's because the interest that adds on to that payment has increased so much in that short period of time that you're putting so much more towards interest now, you can't afford to put as much towards the principal or the purchase price, right? So I thought that might be kind of helpful to lay out some examples there. I mean, generally speaking, at these lower rates anyways, every increase, 1% increase in interest rates can mean 10% or even more potentially, obviously give or take, but 10% give or take of purchasing power for the total home price. So huge deal there, right? And I think that's really important to note. And especially if you are looking at buying, I feel like a lot of people are concerned about rates, but also trying to maybe explore buying before they keep rising. If you are, just make sure you're not overshooting. And if rates come back down, obviously things look better, but that's who knows if that happens, right? All right, the second thing I want to touch on is how this impacts sellers, because just like the buyers here, looking at different financing and getting a little shaky and not quite sure how all this pans out for their future, the sellers have to deal with that as well. So number one, obviously there may be less buyers in the market, because if your home was priced at that $1 million, I'm just going to keep coming back to that example. Home was priced at that $1 million, and now all of a sudden, because rates have risen, the same buyers that you had for $1 million now can only afford $750,000, for instance. You might have just lost a bunch of your buyers. So basically, anybody who was shopping $1 million and below may be out of your market now. Maybe the people who were closer to $1.25 million are now your buyers as opposed to the previous $1 million. So that's number one. Is again, it really affects your buyer pool and the demand for your home. Second is that obviously with the financing, things get a little shaky. Buyers are a little more nervous now. They aren't sure what's coming next on interest rates. And so this can lead to a little bit of uncertainty on the seller's end, because you may not look at a financed offer the same as you might have before. You may take a little more weight for a cash offer or something along those lines, just because you never know what could be happening on the financing end of it. Again, as interest rates rise, obviously it's a little harder to get mortgages as well, just from a pure cash flow perspective. So if you are a seller, these are some things to kind of consider in this as well. Now, again, remember, housing is all supply and demand. Here in Seattle, we do have a shortage of housing for sure. So whether this all means negative things necessarily, it's hard to say. These are more general themes that we may see. And I think we've started to. I think some of the housing has slowed down a little bit, and I believe this is a big part of why. All right, third leg to all this is just how it affects the market in general. So obviously, with what we talked about on how that affects buyers potentially not being able to afford as much, how it affects sellers maybe not being able to sell at the price that they wanted, things slow down, right? If the seller had this number in their head at $1.5 million, let's say, or $1 million, and now they're only finding offers for $750,000 or less, you might imagine that they might not be as excited to sell, first off. And second off, of course, there are less buyers in general too. And so what we start to see is things slow down here a little bit, because sellers aren't as incentivized and buyers can't get quite the leverage that they once could. So that's number one. Number two is how it affects rental markets. So if you have a rental property, rising rates can actually start to help you in the future. Now, this isn't as black and white as the rest of it, but generally speaking, as interest rates rise, for the same reasons we talked about buyers slowing down or not looking at purchasing anymore, that may mean that they go to rentals, right? And so in that scenario, you may see a lot more people renting, And here we go back to the basics of supply and demand. If more people are renting, probably means rents rise. Now that takes a much longer time to work its way through the system. So keep that in mind. This isn't like an overnight thing for rising rates and the impact to the rental market, but it certainly can work its way through that and increase demand for rentals, therefore allowing rental increases in the future. So that's kind of it in a nutshell. I mean, we have a lot to kind of go through here. There's a lot more, as you might imagine, kind of in the nuances, but I just wanted to talk through briefly how these rising rates could impact buyers, could impact sellers, and could impact the rental market and or just the housing market in general. I hope this is helpful. Have a great Saturday. By the way, although the Mariners did lose yesterday, they play again today at 1:30. So hopefully we get back on track. It's funny. I feel like definitely a bandwagon fan here. I've never been a huge follower, but it's hard to not get excited. So, anyways, enjoy your Saturday. Hopefully the sun comes out here soon, and let's go Mariners.